All right, let's dive into one of the most punishing and honestly confusing audits the IRS can throw at you, the Alimony Recapture Audit. We're going to look at a scenario where a taxpayer does exactly what their divorce decree says, takes a deduction they think is totally by the book, and then bam, years later, a notice from the IRS arrives and it completely turns their financial world upside down.
This right here, this is the core mystery we're cracking today. You make a big one-time payment to your ex-spouse trying to finalize things and move on. You deduct it, just like you were told you could, but then the IRS comes back and says, nope. They reclassify almost all of it, and suddenly you're on the hook for back taxes, penalties, and interest. We're going to pull apart exactly how and why this happens, getting deep into the specific codes and calculations the IRS uses.
So here's our game plan. First, we'll look at the fundamental accusation. What's the difference between alimony and a property settlement in the government's eyes? Then we'll uncover the motive, the whole idea of tax arbitrage that makes the IRS so suspicious. After that, we get into the weeds with a specific law, IRC Section 71F, and we will run the exact math the auditor uses. And finally, we'll talk about how this all works today, and most importantly, the key defenses that can protect you. Okay, let's start the investigation. This whole mess hinges on one simple fact. In the world of divorce tax, the IRS sorts every single dollar that changes hands into one of two very, very different buckets. So on one side, you have alimony. For years, this was simple. The person who pays it gets to deduct it, and the person who receives it pays income tax on it. It's an income shifting tool. But on the other side, you've got the property settlement. This is just dividing up the stuff you own together. It's governed by a totally different rule, IRC Section 1041, and it's tax neutral. No deduction for the payer, no income for the payee. The accusation from the IRS is that you've cleverly mislabeled a non-deductible property settlement as deductible alimony, and that's where all the trouble starts. So you might be wondering, why would the IRS care so much? What's the big deal? Well, let's look at the motive. The IRS isn't just making up rules. They're trying to shut down a really powerful financial incentive that was basically baked into the old tax code. This is what's called tax arbitrage. Just imagine a scenario. You have a high-earning spouse in, say, a 37% tax bracket, and the other spouse is in a 15% bracket. By calling a $100,000 payment alimony, the payer saves $37,000 in taxes. The payee only has to pay $15,000 on that income. So between the two of them, the couple just created $22,000 out of thin air. It's like a divorce subsidy paid for by the U.S. Treasury. And you can bet the IRS was not a fan of that. And this is what makes the rules so dangerous. Your intent is completely irrelevant. The IRS doesn't have to prove you were trying to pull a fast one. Maybe you front-loaded the payments for a perfectly good reason, like helping your ex buy a house. Doesn't matter. The recapture rule is just a math problem. If your payment schedule triggers the formula, the penalty is automatic. It is strict liability, plain and simple. So now let's talk about the law itself. The specific weapon the IRS uses to fight back is found right in the Internal Revenue Code. Section 71, subsection F. This is the Alimony Recapture Rule. And trust me, it's a powerful tool. The key thing to understand is that this rule is a forensic tool. It looks back in time at the payments you've already made, and it penalizes what it calls excess front-loading. The IRS's whole logic is that real financial support is supposed to be steady, periodic. A huge payment in year one and then nothing doesn't really look like monthly support. It looks like a buyout. So this rule just automatically reclassifies it. Now, the rule really has three key parts. First, the timeline. It only looks at the first 3 calendar years of payments. Anything after that, they don't care about. Second, there's a safe harbor. It allows for some flexibility. Your payments can go down, but if the drop from one year to the next is more than $15,000, you're in the danger zone. And third, and this is a weird one, the penalty isn't what you'd expect. You don't go back and amend your year 1 return. Instead, the payer has to report the recaptured amount as extra income in year 3. It's this phantom income that just appears on your return, and it can be a really nasty surprise. Okay, time to get our hands dirty with the evidence. We're going to run the numbers exactly the way an IRS auditor would, using the formula straight from their own guide, Publication 504. This is the math that seals your fate. Now, the formula is a 2-step process, and it works in a kind of counterintuitive way. It's reverse chronological. First, you figure out the excess payment in year 2 by looking at how much it dropped into year 3. Then you use that result to help calculate the big one, the excess from year 1. Let's go back to our case study. You paid a single lump sum, $150,000 in the first year. Then you paid 0 in year 2 and 0 in year 3.
This is the absolute classic trap, a scenario that can have just devastating financial consequences.
Okay, first we calculate the excess for year 2. We take the year 2 payment, which was 0, and we subtract the year 3 payment, also 0, plus that $15,000 safe harbor. So that's 0 minus $15,000, which equals negative $15,000. Now, in the world of recapture math, any negative number just becomes 0. So, for our purposes, the year 2 excess is 0. Simple enough. Now for the big one, step 2. We start with the year 1 payment of $150,000. Then the formula tells us to subtract the average of the next 2 years' payments, plus that same $15,000 safe harbor. Well, since the payments in years 2 and 3 were 0, their average is obviously 0. So the math just becomes $150,000 minus that $15,000 safe harbor. And that leaves us with a year 1 excess of $135,000. That's the number, that's the problem. And there it is, that's our final answer. Out of the $150,000 deduction you originally took in year 1, the IRS has just retroactively said, we're disallowing $135,000 of it. They've basically decided that only $15,000 of that payment actually counts as alimony. The other $135,000 gets reclassified as a non-deductible property settlement, and you now have to report that as income in year 3. What's so great about this table is it shows you exactly where the cliffs are. Look at those first 2 rows. Nice level payments? Totally safe. And look at the second row, a perfectly tapered payment that drops by exactly $15,000 a year, also totally safe. But then look at the third row, the failed taper. Even with payments in all 3 years, the drop is just too steep and it triggers a pretty significant recapture. And of course, that last row, well, that's our lump sum trap. Okay, so now that we've seen how the math works, you might be thinking, hey, wait a minute, didn't the Tax Cuts and Jobs Act get rid of all this? And you're right, it did dramatically change the game at the federal level, but, and this is critical, it did not eliminate the risk for everyone. The law drew a very hard line in the sand. If your divorce agreement was signed, sealed, and delivered on or before December 31st, 2018, you were grandfathered into the old system. The deduction is still good, which means federal recapture is still a very, very real threat. For any new agreements after that date, the federal deduction is gone, so federal recapture is also gone. You can't recapture a deduction that was never taken in the first place. That cutoff date is everything. But here is the massive hidden danger today. A handful of big states like California and New York never conformed to the federal changes. They decoupled. So in those states, even for a brand new divorce today, alimony is still deductible on your state tax return. And you know what that means? State tax agencies are aggressively enforcing their own recapture rules. So you might be totally safe from the IRS, but you could still get hit with a huge bill from your state. So let's say the math is pointing right at you. The numbers scream recapture. Is it game over? Not at all. The tax code itself actually provides some very specific and powerful defenses. These are the safe harbors that can save you from an audit. Okay, the most powerful defense by far is in IRC Section 71F5C. It's called the Fluctuating Income Exception, and it is a golden shield for anyone whose pay isn't a flat salary. Think sales commissions, bonuses, or business profits. The rule is pretty clear. If your payments are set as a fixed percentage of your income, and that deal lasts for at least 3 years, then the recapture rule simply does not apply, no matter how much the payments drop. Let's make this real. Imagine your divorce decree has this exact wording in it. In year 1, you're an investment banker. You have a killer year, huge bonus, and that 35% alimony payment comes out to $350,000. Year 2, the market tanks, your bonus is 0, and the alimony payment is 0. Now, mathematically, that's a gigantic drop that would normally trigger a massive recapture. But because the drop was caused by the formula in the decree and not by some arbitrary choice, this exception gives you complete protection. The recapture is 0. It's a perfect example of how the right words in your legal documents can save you from a world of financial pain. So, when you boil it all down, the big takeaway is this. A divorce agreement isn't just a legal document. It's a tax instrument. The specific formulas and the precise language used within it can mean the difference between a predictable financial future and a surprise multi-year audit from hell. Which makes you wonder, doesn't it? Is your agreement a tax shield, or is it a hidden tax liability just waiting to spring?